Hi everyone, it's Jack back with another video, and today I'm going to be talking about Altria Group, a dividend king that's best known for being the parent company of Philip Morris USA, which owns the Marlboro brand of cigarettes, among many others. So it's one of the largest tobacco producers and distributors in the world. Right now it has an 8.11% dividend yield on 52 years of increasing dividends every year. It's been a fantastic company to own over the longer term, one of the highest performing stocks of the last 50 years. This year it's actually smashing the S&P 500, even though it's down 3% year to date. The S&P is down of the order of 20% or more. So it's absolutely destroying the market this year because of the strength of its dividend and the relatively unchangedness of its customer base. We're talking about its valuation, how it returns capital to shareholders, do a DCF, then talk about the future for this business and whether I think it is a buy, sell or a hold. Since 1983, Altria stock has returned just shy of 8,000%. That is absolutely ridiculous and one of the finest performing stocks of the last 40 years. Tremendous returns. It also has been at a tremendous record of returning value to shareholders. It's a dividend king with 52 years of dividend growth, currently at an 8.1% yield, has a 5-year growth rate of 7.89%, sitting at a payout ratio of 76.6%, which is not ideal by any means. I'd much like that to be closer to 50 or under, but it's not outrageous considering the free cash flow this company brings in. In the last 4 years, they've repurchased $7 billion of shares, sitting at around an $80 billion market right now, so that's getting eaten up quite quickly. That's just shy of 10% of shares outstanding. It's paid $29 billion in dividends over the last 4 years, which is outstanding, and has increased its dividend this year by 4.4%. On average, its EPS growth is much lower than the adjusted EPS growth that's gone up this year of 7.9%. We're looking in the 2% range yearly is sort of what this company is doing, because cigarettes are not the fastest growing market around that's based on consumer loyalty and price increases. But that being said, this has been a fabulous company to own and it has rewarded shareholders handsomely. One thing I and everyone really should pay close attention to when looking specifically at dividend king and dividend aristocrats, companies that are known for returning cash to shareholders, and you want them to continue to do that, is the balance sheet. Altria's balance sheet is less than stellar, has a cash debt ratio of 0.09, it's around $2 billion in cash on the balance sheet, and something like $28 billion in debt. That is poor, that is very weak for the tobacco industry, and just very weak for any company in general. A cash debt ratio of 0.09 is quite worrying. It does have an interest coverage of 10, meaning with this year's EBIT it could pay off 10 years of interest on its debt payments, which is sort of the reason why its Altman score is 3.75, which is in the safe reason. The real reason is because last year it generated $8 billion in free cash flow. It carries such low amounts of cash because of the extreme predictability of this business. The infrastructure is already pretty much there. It doesn't need cash much more than to just pay its staff, pay its operating costs, pay its dividends and buy back shares. There's not really any need to pay down this debt when it's such low interest rate. So it doesn't accrue a lot of cash on the balance sheet. Most of it goes to paying dividends and share repurchase, which is kind of exactly what you'd want, because what really is the worst case scenario for a tobacco company like this? It's such a predictable business. Nothing really can go wrong. On a valuation point of view, this company is generally trades lower than the S&P 500 and has done for a long time because of the inherent problems with the cigarette industry and the tobacco industry is that it is declining over time. Now, Altria have got involved in many different businesses. They're potentially involved in cannabis, they're potentially involved in e-cigarettes and things like that. These are burgeoning businesses, but the majority of its revenue is from tobacco, and that is declining, and that is reflected in the PE ratios. Forward PE of 9 and a trailing PE of 18 are both below the S&P 500 averages, despite this being a dividend king, yielding 8% and managing just fine as a business right now. Has a price-free cash flow of 10, which, like the other two metrics, is very, very cheap and below the S&P 500 averages. I would consider a price-free cash flow of below 20 to be quite good. This is not only a good price-free cash flow for any business, but it's actually pretty good value for Altria's historical values, as it's not had the best last couple of years despite being an incredible returner over the long term. Next up is a discounted cash flow calculation to work out a fair value for this business based on the sum of its future cash flows. It's increased its free cash flow 1.7% last year, but it's averaged an increase of 10.9% compound annual growth rate over the last 10 years. I think the 1.7% is close to where it's going to be. For this calculation, I used a 2% growth rate of free cash flow over the next 10 years and a 2% terminal stage value with a 9% discount rate. That gave me a fair valuation of $47.65, which is pretty much on the nose of the current stock price at $46. Meaning this company is about fair value, a reasonable price to pay, by no means a bargain based off these estimates. Of course, if you think that the free cash flow is going to decline, which for me, over the next 10 years particularly, I don't see why it would. The tobacco industry is not really going anywhere. While people are, uptake is going down and customer loyalty is still really strong, price increases are certainly going to continue going forward in my opinion. And I think Altria can manage the decline of the tobacco industry well enough by increasing prices to be able to increase its free cash flow 2% over the next 10 years, which is a relatively modest increase. These are Altria's own statistics on adjusted cigarette industry decline rate. Right now, the 5-year average is a 4.5% decline. Of course, they are managing that well with price ranges and also trying to invest in other ventures. They have a 35% stake in Juul, the e-cigarette manufacturer. They have a large minority stake in Anheuser-Busch InBev. They have a stake in Kronos, a 45% stake in the Kronos Group. They're trying to manage it in other ways, but the core tobacco portfolio is declining over the long term, and this is a long-term headwind for this company that they have to manage with price increases. The real shining light for Altria is its moat, which is extreme brand loyalty in the tobacco industry, much higher than associated industries such as alcohol, groceries, household items, anything like that. Brand loyalty is nowhere near as high as it is in the tobacco industry. If you smoke Marlboro, you are likely to always smoke Marlboro unless you quit, and if you don't, you're quitting cigarettes. It's quite sinister in a way because it essentially boils down to the addictiveness of tobacco and nicotine, but that is the world we live in, and in this sense, tobacco has excellent consumer brand loyalty and is really why Altria can have pricing power over the long term. Overall, I think this stock presents an interesting proposition. One thing that I don't think it is a never sell. The tobacco industry is declining. There will come a point where this is an unownable business. I just don't think that's going to be at any point in the near future. In the next 10 or 20 years, this will be a fine hold in my opinion. It has excellent dividend yield. It's trading at a reasonable valuation, has insane consumer brand loyalty, an excellent moat, and its stock price generally doesn't do that much on a yearly basis, and it returns capital to shareholders at an excellent rate. It's repurchasing shares at a fabulous rate. So I am not concerned about Altria's viability or strength of the business over the next 10 or 20 years. Over the longer term, I think there is going to be an extreme decline in tobacco use, and I don't think Altria's other investments are going to be able to essentially take over this revenue. I just don't believe that the e-cigarettes and the marijuana industry are going to be able to accommodate for Altria's revenue, which is enormous. That being said, personally, I just don't like investing in tobacco products. However, an 8% dividend yield is attractive to many. I would not frown upon anyone for buying this business. An 8% dividend yield at this sort of price is fabulous. So for me, I just don't really want to buy this business. I would prefer to buy other dividend kings and take a slightly lower yield for a company that I could think about less, because in my opinion, I don't think it's right to be buying a company that is potentially going to be out of business, or you can see a future where it's out of business in 30 or 40 years. I prefer to buy the never sell type of businesses. With that being said, this is just my opinion. You should let me know in the comments below what you think about Altria, what you think about its dividend safety and its future. Let me know in the comments down below. I'll see you again next time.